According to a study conducted by the Financial Industry Regulatory Authority, or FINRA, 66% of Americans are unable to get more than 3 of the 5 financial literacy questions correct. The questions consist of topics that we encounter in everyday lives, such as concepts of compound interest, inflation, diversification and investing, mortgage payments, which are all essential basic knowledge that you need to know to grow your wealth. Today, I want to go over these 5 questions and the solutions. So pause the video if you need more time to solve each question and try to see if you can get all of them correct. Question 1. Suppose you have $100 in a savings account earning 2% interest a year. After 5 years, how much would you have? So if you chose more than $102, you are correct. This one is a fairly simple math question. So you start with $100, then after 1 year, you get 2% of the $100, which is $2, for a total of 102. In year 2, the interest rate is the same, but the total amount you have in the account is increased. So now you get a little bit more at 204. Year 3, you get 208. Year 4, you get 212. And finally, at year 5, you get 216. So by the end of year 5, you would have collected $110.41. That may not seem like a lot, but over a longer period of time, the snowball effect really starts building up, especially if you have a larger amount of money saved. Conversely, this concept can also be applied to calculate how much your debt is going to grow on an annual basis. It's especially scary to think about when you have a credit card loan that you have been not paying off, with a significantly higher interest rate. Question 2. Imagine that the interest rate on your savings account is 1% a year and inflation is 2% a year. After 1 year, would the money in the account buy more than it does today? Exactly the same? Or less than today? Since inflation is increasing at a higher rate than the interest you're earning from your savings account, your money will have increased in number, but not in terms of value. Say if you wanted to buy a pair of shoes that is selling for $100 and you only have $100, so you put your money into a savings to get the extra dollar and make your purchase the next year. But since inflation rises by an average of 2% a year, those shoes will cost $102 next year. So you will still not be able to afford those pair of shoes. To make matters worse, the value of your money sitting in your savings account will continue to diminish in relative value because of inflation. Question 3. If interest rates rise, what will typically happen to bond prices? Rise, fall, stay the same, or is there no relationship? This one may stump some people because not everyone is invested in bonds and they don't really teach this type of stuff in school. The interest rate here is talking about the federal interest rate. It's the rate that the Federal Reserve sets for banks to loan money. So if Bank B needs money, it will borrow from Bank A at a set interest rate. Let's say 1%, 0.01. And then Bank B will take this borrowed money, charge a higher interest rate, then loans it out to you and me, or even to bigger corporations. Let's say 5%. So going back to the scenario provided, the interest rates are higher, which will make bonds more valuable, right? Well, the issue is when bonds are issued, they have fixed interest rates. So when interest rates go up, the old bonds that were issued earlier give you a lower interest rate compared to the new bonds. And so these old bonds that were issued are less appealing. So those bond prices fall. On the other hand, if interest rates go down, bond prices will go up. Question 4 is a true or false question. The question is, a 15-year mortgage typically requires higher monthly payments than a 30-year mortgage, but the total interest over the life of the loan will be less. Again, they don't really teach us about mortgages in school, so unless you own a home or are interested in owning a home, you may miss this one. Since most homes in the US will cost you several years' worth of wages, most people cannot afford to buy a home using cash. So you get a mortgage or a loan from the bank that requires you to pay back a certain amount with an interest, of course. The length of the mortgage is how long you plan to take to pay off the loan. The 15-year and 30-year mortgage terms that are in the question are the two most common terms you'll see. So if you can choose between the two, you would obviously go for the 30-year, right? Well, while a 30-year mortgage means you will be making less in monthly payments, the catch is that they charge a higher interest. This makes sense because time is money, especially in finance, and the trade-off here is you pay a higher interest rate for taking more time to pay off your loan. So the answer to question 4 is true. Question 5 is also a true or false question. The question is, buying a single company stock usually provides a safer return than a stock mutual fund. This question could be seen as tricky for those who are not familiar with how a mutual fund works. Simply put, you can think of a mutual fund as a collection of stocks and other forms of investments. The big benefit of investing in a mutual fund is that you don't have to do your own research. The fund managers will do the research for you and allocate your capital. And each mutual fund usually has a targeted type of investment, such as large cap, small cap, technology, or even countries. And so the simple answer to this question is mutual funds are considered safer than holding a single company stock because a mutual fund holds a variety of different stocks. It doesn't put your money into one basket. Thank you guys for watching, and let me know how many questions you got right or wrong in the comments below.